Hello and welcome. You are watching live budget coverage on ICICIdirect platform, and I have a very special guest, Mr. Pankaj Pandey, Head Research, ICICIdirect, to talk about the budget. So budget is finally here, Pankaj. It has been presented and a huge capital expenditure announcement this time too. So what is your reaction to the budget?
Hi, good afternoon, Gitu. I think we need to sort of see the budget in detail, but overall, from the numbers, what we have seen, and from the budget speech, I think the budget looks very realistic. In fact, it's more conservative because what you are expecting is about 11% kind of a nominal GDP growth rate in FY23.
Right.
So, which means that somewhere down the line, budget is also factoring in case if there is a fourth wave, probably it could have an impact on the overall corporate and the economic performance.
Mm-hmm.
But keeping that aside, I think the highlight of the budget is obviously the capex. One, I think FY22 revised estimates, the capex is revised by another 50,000 odd crores. So roughly from 5.5 lakh crores, it has gone up to 6 lakh crores. And on top of it, you are again looking at a capex figure of 7.5 lakh crores. So I think that's a sort of a highlight of the budget.
Sorry. We're still not live. There is some technical issue on the website. Sorry. We will have to start again. 2 seconds.
Coverage on ICICIdirect platform powered by Investonomics. And now the budget has been presented. We have a very special guest with us, Pankaj Pandey, Head Research, ICICIdirect. Pankaj, your first view on the budget. How do you rate this budget?
So I think it's a budget on expected lines with a sharp focus on capex, and which is the sort of the need of the hour. And I think from the numbers, what we see, it's a very conservative budget because we're looking at about 11% kind of a nominal GDP growth rate next year. RBI's projection for inflation is about 5%. So that means what you're penciling is about 6% kind of a real GDP growth rate, which is very conservative. And I think the backdrop to this could be a potential fourth wave or a fifth wave or a COVID-related disruption on the overall economy. So from that perspective, it's a very conservative budget. And I think in FY22, we are expecting about 17-18% kind of a nominal GDP growth rate, which is on expected lines.
Okay.
I think like I said, the highlight of the budget is the higher capex spend what government is looking to do.
Mm-hmm.
Budget last year projected a capex of nearly 5.5 lakh crores. Now that number is revised for this year itself to about 6 lakh crores. And on top of it, also, you are expecting a good growth to nearly 7.5 lakh crores. So I think that is one figure which is extremely good for the markets and is very positive for a number of infrastructure segments, like, say, for example, road, railways. Then I think there was a mention of river water linking also. And we understand that, say, for example, a particular project which has been sort of approved was Ken-Betwa River, which was the size of 40,000 odd crores. So this is also a sort of a new segment which is coming up. And I think the good part is that besides the government pushed capex, what we are seeing, so I think the private capex is also being encouraged, and which is where we have seen probably the PLI benefits coming from the here and wearable side. I think the quantum and the overall specifics is yet sort of not known. But what the government is looking to do is that it is pushing its own pedal through its own capex or public expenditure, public capital expenditure, and also it is encouraging private sector to sort of do more spending, especially through the PLI scheme, and again to new age sectors. So from that perspective, you're sort of changing the color of the overall GDP growth what you're looking at. So that way, I think budget is very progressive in terms of or growth-oriented budget from the perspective that you're pushing capex, because capex solves a lot of problem in terms of higher or better economic growth. Then an after effect of a good capex is also the employment generation and also the lifting of the poverty. So from that perspective, these are the positive ones. I think where the market are seeing a bit of a muted reaction is largely on the divestment side. Because last year the government was expecting closer to 2 lakh crores. So now that number is revised down to about 78,000 odd crores. But I think for next year, FY23 numbers are sort of a bit soft from the perspective that you are still looking at a lower number compared to FY22. And mind you, you have spillovers of say IDBI Bank or BPCL, which is what the government was looking to do. So from that number, that looks off. But I think a context to that could be that the government is very conservative. Like if you look at the GDP growth rate for next year, that's pegged at 11%, whereas now most of the economic projections are hovering 7% or 8%. So from that perspective, I think the government has taken a sort of a conservative stand, and they would want to sort of beat or outperform these numbers going forward. And I think that is also reflected in revenue growth numbers also. So from that perspective, it's a conservative budget, and so it's like they want to sort of talk less and deliver more. So that is what I think has been the highlight of the budget.
Pankaj, last budget resulted in the re-rating of some of the sectors like your infra, capital goods. So what is expected this time? What are the sectors that you expect should do better and be stronger as based on the budget for FY23?
I think since capex is the major focus, so obviously the beneficiary of the entire ecosystem. So obviously one beneficiary of this entire ecosystem will be the overall banking sector, both PSUs and private put together. Because up till now, the credit growth has been a bit soft, and expectation was that a big capex announcement would lift that credit growth to a higher level. So banking obviously is a sort of a bigger beneficiary. I think the only sort of negative is that since the government borrowings or the fiscal deficit numbers are higher, so bond markets are not taking these numbers they're taking it in a sort of a negative way. But banking overall is expected to benefit because one, structurally your credit cost is sort of coming down, and credit growth was the only variable which was missing in the overall banking as a pack. And then beside that, capital goods and infra is another set of companies what one should look at along with cement. So in the capital goods, again, since you are sort of doing a lot more capex, I think both short cycle and long cycle product companies will benefit from this. And mind you, this is a capex which is entirely different from what we have seen historically. For example, data center getting an infrastructure status is something new which we haven't seen. And mind you, data as a center requires good amount of capex because it's usually measured in megawatts because power is the main consumption there. So capital goods is another sector which should benefit. And beside that, since the allocation towards road, railways plus water is on elevated levels, so we'll have road EPC players and other EPC players which will benefit from this kind of an opportunity. So I think banking, capital goods, and infra are good. Then I think for any kind of a housing project or any kind of a infrastructure project, you require both cement as well as steel. So obviously, ancillary benefit will go towards cement and steel. In cement, structurally, it is expected that they'll grow higher than the overall real GDP growth rate. So, which is why a cement industry sort of delivering 8 to 9% kind of a growth will look very much possible. So, I think these are the pockets where we would expect a positive rub-off from the budget once this entire detailing of the budget is done and the sinking or the entire budget is digested.
Pankaj, one last question. Emergency credit line guarantee scheme extended till March 2023. How do you think this is going to help the MSME sector? And will this help in real job creation, which has been missing till now?
Absolutely. I think MSMEs have been impacted the most. In fact, 80-85% of the job creation is with them. So this is one pocket which has been badly impacted. And like I said, I think government is yet not sort of turned overconfident that COVID is over. So which is why they would want to sort of maintain the easy credit lines or maintain that easy liquidity ecosystem for MSMEs. So I think this is a step in that direction. And I think in case if we don't get, our sense is that government is going to comprehensively beat most of the numbers what they have penciled in the budget. So from that perspective, I think the numbers or the segments what they have focused on are in the right direction.
Pankaj, but all the assumptions have been made at crude between 70 and 75. But if the crude prices surge beyond $100, which many of the reports are pointing to, then what happens?
Correct. So obviously, crude historically is not expected to remain at elevated levels. Now you have a geopolitical tension because of which crude is expected to remain at elevated levels for some time. But it is very difficult to sort of pencil in crude at elevated levels because somewhere down the line, then you will have other segments start looking attractive. So whether shale gas production can obviously go up. So so you have number of things which can sort of do. But I think the good part is that since you have prepared a conservative budget, especially say for example, divestment target being far more lower, obviously you can sort of divest a lot more and raise more resources. So that way, I think budget is sort of figuring or the risk is on top of the mind compared to the opportunities which could unfold next year. So, like I said, it's a more of a conservative and a budget with a sharp focus on infrastructure.
Questions don't end when the budget day is here. Last question, digital rupee to be rolled out by 2023 and cryptos to be taxed at 30%.
So I think one good thing is that rather than sort of killing cryptos, you're looking to sort of tax them and benefit from this, the volatility what you see in cryptos. So that's a sign of a relief. I think cryptos need to be sort of understood in terms of risk and the kind of return what it offers. But I think as a first step, it needs to be regulated. I think which is where I think the government has taken that primary step. The other thing is that digital currency, so both crypto and digital currency, the technology background is largely the same, which is blockchain. And see, digital currency will have a lot more benefits because if I recollect it right, we spend more than 1% of the GDP on physical management of the currency in terms of printing and circulation. So if you are able to sort of migrate some portion of that towards digital currency, then I think it's a sort of a saving which directly flows into the bottom line of the government. So I think so this move was a good measure to sort of improve the overall economic efficiency.
Thank you so much, Pankaj, for your time. Thank you so much.
Thank you so much.
Hello and welcome. You're watching a very exclusive conversation with Mr. Pankaj Pandey, Head Research, ICICIdirect. Let us talk about the stocks that would be impacted by the budget which has been presented by the Finance Minister this afternoon. Pankaj, which are the stocks that you are now looking at post-budget?
So I think pre and post budget are largely we were focusing on capex being the primary driver for the budget and for the government. And I think that has largely sort of panned out. So my pre and post budget recommendations largely would not be very different. Now, prior to budget, since capex was a big theme, so which is why we believe that a stock like L&T deserves to be bought at current levels because in terms of recent con call, they highlighted that the tendering activity in Q4 is going to be very robust. And budget also is sort of highlighting a good amount of allocation towards capex. And L&T is expected to be a big beneficiary of that. So, which is why L&T with a target price of 2168 is what we would prefer. Then road is another segment where our sense is that you'll have companies like KNR and PNC ideally will benefit. Along with that, these companies also have a good amount of exposure on the water or irrigation project, which the government is also sort of driving through. So, a company like PNC Infra is what we would prefer. Then, besides that, since capex is a theme, and obviously banks will be a beneficiary of this particular theme. Axis Bank with a target price of 870 should get preferred, or we would suggest that. Actually, because one, I think banking overall, the credit cost is coming down. Capex was something which was missing as a piece. And structurally, we've seen that private sector banks have done well. So Axis Bank has got a good exposure on the corporate side. So which is why this bank. And I'm also willing to put up PSU Bank, Bank of Baroda, where our target price is 120. Now here we would want to believe that one overall the capital adequacy ratio for PSU banks have improved. One, the other thing is that largely the credit cost is sort of coming down, and PSUs have even bigger or a higher exposure on the corporate side. Or the capex side, so which is where we believe that some of the efficient PSU banks can be looked at, and Bank of Baroda from that perspective fits well. Then, in addition to that, I would want to believe that since the government talked about the Gati Shakti project, where they are looking at an integrated multimodal logistic system. So I think Container Corporation is one company which can be looked at from both perspective of it being a big beneficiary of the overall logistic infrastructure what the government wants to create. Because if you have to promote manufacturing, you would need a very efficient logistics system, and which is where I think Container Corporation fits in. And I think an icing on the cake or a silver lining for this company could also be that since this is a divestment candidate, probably it could next year. Probably this company could benefit from more efficient management when the ownership gets transferred, because what we see is that in terms of realization, what it gets for per ton TUEs or container is 1/3 of what a private player gets. So obviously, this company can do a lot more better with the numbers in an efficient management, and which is why we feel that Container Corporation of India looks very attractive. So this can be bought with a target price of 698. Then I think since there will be a higher demand for metals as well as cement, so in metals, national aluminum is what we like. Now we know that steel is being sort of bit volatile, largely because of the rising coking coal prices. But aluminum is the only commodity in the last 12 months which has been on a higher side and hasn't seen any kind of a dip. And National Aluminium operates in the aluminum space, and also from the perspective that since it's a PSU, it could also be a potentially divestment candidate, because government would not, it is not one of the core areas which the government would want to sort of retain the company. So which is where national aluminum with a target price of 125 is what we would suggest. Then I think in defense, government talked about a lot more indigenization, and then they would. So from that perspective, we would expect that more domestic content oriented defense products will get produced, and which is where we feel that a company like Bharat Dynamics can do well. Here, we would want to believe that last year has been decent, and I think next 2 years, if a lot more indigenization happens, then the revenue opportunity for a company like this goes up. So, which is why this company. So, I think these are the stocks we would suggest, and we feel comfortable recommending at current levels.
Mm-hmm. Pankaj, what is your stand on real estate sector? We didn't get anything directly for real estate sector, but yeah, PM Awas Yojana got a boost of 48,000 crores allocation for FY23.
So yes, so largely I think up till now the government's focus has been providing water and housing to the rural households as well as poor urban households. So that has been the focus. From a listed side, you really do not have many companies which will benefit except for companies on the financing side. But having said that, I think obviously it benefits the ecosystem in terms of better steel demand as well as cement demand. Nothing much from that side, but I think real estate as a sector is already witnessing a revival, largely because of number of demand supply factors which the government has. I think the tide has changed post RERA and post ILFS crisis, and which is why I think real estate has been one of the better performing sectors. And I think whether you look at most of the revenue bookings for most of the leading players is coming at elevated levels. And since these factors are already sort of helping, I don't think an extra push was required for real estate. I think whatever is required for real estate to perform is already there on the table.
Thank you, Pankaj, for your time. It was a pleasure speaking with you. Thank you so much.
Thank you so much.
Hello everyone, I'm Kajal Gandhi, research analyst from ICICIdirect. I'm specializing in the banking sector. We in the budget have seen today a lot of announcements. Within that, couple of things like a higher fiscal deficit, which we have already seen in announcement for the next year, is actually impacting the bond yields. When we see the bond yields are rising, it means the PSU banks particularly have some impact on their treasury gains, and which is on the negative side. So that is one area which we have seen maybe marginally impacting the PSU banking sector. But on the other side, the higher capex which they have announced is going to definitely fuel the growth for the banking sector in terms of higher credit offtake by the industry segment. So that is what is expected to help the larger banks who are into large infra financing or the large capex financing. So in the value chain, we should see the corporate banks, also the overall larger banker fraternity to get benefit of the higher credit growth. If you look at the focus has remained on the digital payments also. The digital payments benefits incentives which were there last year have been continued. Apart from that, we have seen digital rupee will be launched by digital currency will be launched by RBI in the next financial year, and which should actually be a good thing to see, because with all the other types of currencies hovering around, official currency will be a lot more helpful, and also it will further fructify the digital channel which we are looking at. The marginal thing which has come is on the taxation side for these digital assets. So these virtual assets are on the transfer expected to be taxed at 30% on the gain amount. And also for making the payments, whenever anybody is making the payment for these digital assets, we are going to see a 1% TDS requirement. So these are a couple of developments on the digital side which was announced in the budget. In the MSME sector, if we look at the ECLGS scheme, which was there and which had been quite successful in the entire this COVID period, we expect the extension of the scheme by the government to 2023 is March 23 is expected to be reaping more benefits for the overall banks, particularly the MSME heavy banking stocks which are very large on the MSME book. They are expected to do be benefited because of this. On the larger side, if we look at the banks per se are expected to have the benefits of credit growth, digital, all these from the budget, and we should say positive on this sector. Thank you.
Hi, I'm Shashank Pinodia, tracking automobile and auto ancillary space at ICICIdirect. The key takeaways from the recently announced Union Budget 2022-23 for the automobile sector are: first and foremost, government has recommitted its commitments towards augmenting farm income by support to the startup ecosystem for adopting technology in farm practices. This is indeed positive for the domestic tractor space. To further promote electrification, the government has proposed to come out with a battery swapping technology policy, which also includes the concept of battery and energy as a service. This will help in developing requisite charging infrastructure domestically and is positive for the domestic EV space. Government plans to promote private enterprises to incur capex in this domain. In a boost to commercial vehicle space sales, the government has allocated robustly towards capital expenditure at roughly 7.5 lakh odd crores, which is up 35% on Y&Y basis. The government has also extended that eligibility timeline for concessional tax rate, with commissioning now extended beyond 2023 to 2024. We believe this will drive private capex cycle and is positive for commercial vehicle segment. To summarize, we see this budget as a growth-oriented budget with focus on capital expenditure and is positive for commercial vehicle space as well as tractor domain. Thank you.
Yeah, hi all. A very good afternoon to you on this budget session from ICICIdirect.com. I am Chirag Shah and I track capital goods and the power sector. So the budget has been a quite progressive one in terms of allocating funds to the capital expenditure requirements of the country. And one thing is pretty clear that if India wants to achieve the aspirational goal of $5 trillion GDP in the next 3 to 4 years, manufacturing, capex, and infrastructure growth is the only roadway. And we believe that the government has rightfully uh, jotted down on the sector which needs to take the leading position for India to take to that aspirational goal of $5 trillion. And if you look at the kind of allocation the finance minister has done in this particular budget towards the capital expenditure segment, the stands at rupees 7.5 lakh crores, which means a growth of 35% on a year-on-a-year basis. And that too, one must be cognizant of the fact that last year also we had a very hefty allocation towards the capital expenditure segment. And mind you, one beautiful thing that has happened is that the government has budgeted for the total 5.54 lakh crores of capex that was announced that last year. So without any slippages, the government is further building up a 35% growth in the capital expenditure towards this particular year, that is FY23. So what does that mean for the capital goods sector as a whole? So if you look at the key segments or the drivers under the capital expenditure segment, which is like railways, roads, water, defense, and other segments like metro, urban transportation. So they will see a huge amount of investment in that particular sectors. And the companies listed in the sectors which cater to this particular segment, maybe be a EPC-based capital good companies like a Larsen Toubro or a Thermax, or a product-based EPC or product-based company like a Siemens, like an ABB, bearing companies like an SKF, Timken, NRB Bearings, or the companies which are into specialized products like consumables like Adore Welding, ESAB India. These companies, if the way the things have been presented in the budget pans out on the ground, there will be a phenomenal growth in the demand uptake for all these particular companies. They will see huge amount of order inflows, which will lead to strong execution in top line. And because of fixed cost nature of the business and high operating leverage, you will see a supernormal delta on their profitability, and which will lead to again further re-rating for this particular companies. So in our way, to sum it up in a nutshell, the budget has been quite positive for the capital goods sector per se, and we believe that uh, the sector that to be in for the next 2 3 years is definitely manufacturing and capital goods. Thank you.
Hello, good afternoon, everyone. This is Rashesh Shah from ICICI Direct Research Desk, and I cover cement sector. So, from cement sector perspective, we see this budget to be a pro-growth, and we expect cement demand to get boosted very much as the government has specifically put a more emphasis on the capital expenditure, and for FY23, the capital expenditure has been increased by 35%. To almost over 7.5 lakh crores. So this is obviously gonna provide impetus for infrastructure development by the government, which we have seen some moderation in the later half of this fiscal. So overall, this we see the cement demand again to get accelerated going forward. And even if you see the overall budget, then government has put more emphasis on the tax revenue front, and government is now started relying on more on tax revenues rather than on the capital receipts. So we also see this as a structurally positive budget and we expect overall tax to GDP ratio to also improve to almost about 11%, which has remained almost below 10% so far. So we remain bullish on the cement sector. That is what I want to say. Yeah, thank you.